The biggest banks and hedge funds don't want you to know that they leave footprints in the markets every single day that they place a position. And those footprints, well, they're visible to literally anyone who knows where to look. Because after 9 years of trading and becoming the first trader to pull a 6-figure payout from a prop firm, I can tell you that retail traders fail because they're playing a completely different game than the institutions. In this video, I'm going to pull back the curtain on how many institutional traders approach the markets and how, more importantly, you could use those same insights to level the playing field. Now, institutional orders are just simply too big to hide. Institutions, you have to think about, trade massive size. They're moving millions upon millions of dollars and at a time are trading hundreds, if not thousands worth of futures contracts. And you just trading price action alone, you're not going to be able to see this. But when you dive deeper and you start looking into the order flow data, whether using a quick DOM or a heat map, you're actually able to see where these institutions are getting filled inside of the markets. And you're actually able to see on the order book itself where these institutions have their positions placed. Now, the majority of the time when an institution is actually trying to take a position inside of the market, they're using a limit order as a passive participant, because if they use a market execution order and execute hundreds of contracts at once, not only are they going to have problems getting filled because of the sheer size of orders you're trying to execute inside of the markets, but they're also going to cause a massive spike in price, and they're going to reveal what their hand and what their intent is behind what they're trying to do with their positions, which would leave them exposed. And this is where using a quick DOM, a footprint chart, and a heat map comes into play, because you can actually see where these institutions have their positions resting and where their limit orders are sitting on the order book. And you can even see and use indicators such as absorption indicators and indicators such as the iceberg indicators that allow you to actually see these institutions getting their positions filled in real time, allowing you to make better trading decisions, which is just simply something that you're not going to be able to see trading price action. And when you look at the bottom line of it all, you're actually able to see what the institution's intentions are with their position and how the market is reacting to their orders getting filled, which will give you better trading decisions on a day-to-day basis. And just to add on to that, when banks and institutions are trading, they're not clicking buy or sell on a market execution order like a retail trader. They're moving hundreds, if not thousands of contracts at once. And to get filled, they need massive liquidity, which only exists in certain places on the order book. Now, liquidity comes from stop losses, pending orders, crowded areas where you typically see a lot of retail traders piling in. And that's why you'll often see the market push above a high or below low, triggering these orders, and then it suddenly reverses. And I know it may look random, but it's not. It's the institutions using these orders to fuel their positions overall. Now, this creates predictable patterns such as stop runs, fake breakouts, absorption zones, and sharp reversal areas around high volume nodes, and banks are just simply hunting liquidity so they could quietly get in or out of size. Now, the difference here is that retail traders see a breakout and they see the prices ripping through a key level and think, I'm going to jump in on this breakout, while the institutions see liquidity. They see that the stops are being triggered and they see volume flooding in, and they use that momentum to fill the opposite side of that trade. So while retail is chasing price, institutions are patiently waiting for liquidity. And once you understand the difference, you start to see the market in a completely different way. Most retail traders are just simply focused on indicators. Their charts are filled with RSI, MACD, moving averages, all trying to find that magical signal to buy or to sell. But institutions just don't care about indicators. They care about supply and demand and liquidity overall. They're looking for where orders are stacked, where stops are sitting, and where they can enter with size. When new traders come to me, I see the same thing over and over and over again. Their charts are just overloaded. They're chasing signals and they're hoping an indicator will give them that certainty, but that leads to an approach that almost always brings inconsistent results. And here's why. Technical analysis by itself just simply isn't enough. Patterns and indicators can show you what price is done, but they don't explain why price moves. They don't show you the actual behavior of large players who control the flow of the market. Once you start to understand institutional behavior, everything changes. You begin to see the market through the lens of supply and demand, through liquidity, through order flow, and you stop guessing with indicators and you start anticipating where price is most likely to react, because you're aligned with the same forces that actually move the market. So what you guys currently see on my screen right now, it is going to be the volume profile. What the volume profile shows us is how much volume is being executed at each one of these price ranges throughout the day. Now, this volume profile is currently only measuring the New York session open all the way to market close. Now, we could use the volume profile for a multitude of different things. What I'm going to explain to you guys is the volume profile and all the different things that I look at on the volume profile, and why it's important to incorporate the volume profile into your trading system, even if you're not an order flow trader. Now, this is one of the tools that I use on a daily basis religiously. I would never trade again without a volume profile. What this shows me is high volume nodes, so areas of high liquidity. It shows me low volume nodes, areas of low liquidity or low transacting inside of the market. It shows me the area of fair value and where the auction is balanced. And it also shows me the value area low and the value area high, along with the POC or the point of control. So what the point of control stands for, it is the one price point throughout the entire trading day where the most volume was transacted. So you can see in today's market condition, the most volume was transacted at 6701.5. Now, just beneath that, we have the value area low and we have the value area high. So when you think about the value area low and value area high, you have a middle ground called the value area, where you also have the point of control as well. When you have a value area, this is where the auction is fairly balanced, and this is where a lot of the market participants deem the auction to be an area of value. Now, when you have, and it's funny because when you look at ICT traders, a lot of the concepts they trade are fair value gaps. When you have a break away from that value area and the market starts to generate value higher in the situation, you have what's called a fair value gap, or you have a low volume node in all reality. The problem with ICT traders specifically is that when you actually look at the thesis behind a fair value gap, it's not that far that it's incorrect. What happens is when you have a breakout inside of the market, in this situation, since we had a breakout to the upside, that's caused by a lot of aggressive buying. So what that happens on the order book, it leaves a low volume node, which is what would be very similar to a fair value gap is. The only difference is when you're trading ICT and you're trading price action alone, you can't actually confirm where that fair value gap actually was printed inside of the markets. So there's multiple, time frames that we can also look at here as well to confirm these different tools and what we're going to be looking for. One of the main things that I look out in the volume profile for is going to be accumulation and distribution, and really see what the theme and the narrative of the market is at that point in time. So this is going to be a volume profile plotted on a 5-minute time frame. Now, if we actually look at the volume profile plotted on this 5-minute time frame, you could see where the majority of accumulation was on the day and where these institutions were really stacking in their positions. What we also have that I didn't mention here on the volume profile is these lines that are in red and green are going to be the delta at each one of these prices. What the delta is, it is the result. It is the net difference between the buying at the ask and the selling at the bid. So whenever you see a red delta, that means there was more selling. Whenever you see a green delta, that means that there was more buying. So now what this allows us to do is it allows us to see accumulation and absorption inside of the markets. Now, the best way I can explain absorption to you guys is I want you guys to imaginarily grab a bowl. You're going to put water inside of that bowl. You're then going to grab a sponge. You're going to squeeze the sponge, place it in the bowl and let go of the sponge, and you're going to see that sponge absorb all the water around it. And that's the same exact thing when it comes to absorption in the markets. What you're going to see is passive limit orders absorbing the aggression from the aggressive participants using market execution orders inside of the market. So that's the same exact concept. So when we actually look at this market here and we actually look at the volume profile, what we could see is one of two things. We could see the area of fair value, which what I'm going to do is I'm going to grab a rectangle and I'm going to mark up the area of value here and the area in the zone of accumulation within inside of this trading day, which you could see how there's a bell curve here as well. So you can see in between these two price ranges, 67.15 and 66.94, this is where the institutions and the larger participants were accumulating their position. This is where the auction was fairly balanced. And you could see once we broke out of that accumulation range, we had a distribution to the upside. Now, how can we confirm that this is a range of accumulation? It is by looking at the absorption inside of the markets. So what I'm going to do is I want you guys to pay attention to this area all the way down here. This is going to be a value area low since we're starting to deviate away from value and we're getting towards the edge of value here. What you could see is this is going to be the CVD. This is going to be cumulative volume delta. Now, what cumulative volume delta is, it is the amount of volume that is getting executed at the bid and at the ask in representation of candlesticks in this situation here. So whenever you see that there's a red candlestick, you're going to see that there was more orders getting executed on the bid. Whenever you see that there's a green candlestick, there was more orders getting executed on the ask. So essentially selling and buying as a regular candlestick would be, except this measures the cumulative volume delta throughout the entire session. So what you can see throughout this entire session is that the delta is significantly bearish. This is going to be the middle price. So whenever the delta is positive, that means that there was more buying on the day. Whenever the delta is negative, that means that there was more selling on the day in that situation. So now when we actually look at this area area here, and we can actually look at the delta here, you can see how aggressive the sellers are getting as prices coming back down towards the edge of value. Now, we actually start to look at and compare the cumulative volume delta to the price action. We can see that sellers are getting aggressive and they had follow through here. Next candlestick, you can see that the sellers again are getting aggressive as we're approaching the edge of value, but we have a bullish candlestick. So that's going to be delta divergence. And what that lets us know is that we have passive buy limit orders inside of this area absorbing all of that selling pressure. And you can see the discrepancy there. Notice on how this previous candlestick, this large bearish candlestick that we have in this 5-minute time frame, we had a lot of selling and there was a follow-up and a follow-through with the price action. This is something that's confirming strength. But on the next candlestick, we could see the sellers tried to get aggressive again to break through the edge of value and to break through this low of day, and there was no follow-through. It's kind of like almost the sellers were hitting the floor here and they couldn't get through this floor on this attempt here. And you can see that how the candlestick actually flipped and closed bullish. That is delta divergence. That is showing us again that there's absorption here and that there's buy limit orders being filled inside of the market. So again, these aggressive sell limit orders are hitting these buy limit orders, but these buy limit orders are reloading on the order book, absorbing that pressure. That is a sign of accumulation inside of the markets, especially in an area where the auction is deemed as balanced. That's the most important part here, is when you see that the market is trying to break away from that balanced area or the consolidating area, and you can see on the volume profile that this is going to be the edge of value, which you can see with these blue lines here, this blue line here and this blue line here, that is going to be the edge of value. So inside and in between these two blue lines where you have this high volume node where you can see how much volume was transacted here, you could see that this is where the institutions are accumulating their position, and then you can also confirm it with the absorption down here as well, getting ready for that big move. So now let's look at this next candlestick. You can see again, these sellers are getting aggressive. You can see that this candlestick is bearish, meaning there's more orders being executed on the bid, meaning more aggressive selling is coming into the market. But again, the candle closed bullish. That is a second attempt from the sellers that again are punching that wall that cannot get through. Then you can see here the third attempt from the sellers. Sellers again are getting it aggressive. The delta is still dropping. CVD is still dropping, yet the sellers did not have a follow through. There was no reward for all of this aggressive selling for 15 minutes. So you had 15 minutes of participants trying to short this market and they were failing to get beneath this value area low or beneath the area of value. What ended up happening here was you could see now buyers are starting to come into the market. You can see the strength here on this candlestick, and then you can also see the buyers really came into the market on this candlestick here too. So the real question is, how can you take advantage of this? Well, once you identify this right here, you can also have a large trade indicator. You can wait for a big buyer to come in and to really start pushing this market up to increase the probability of the setup. Is really, you could also look at a footprint chart. What this shows us is every single order that's executed on the order book leaves behind a footprint. So the way I would anticipate and look at this is identify where the value area low is. So the value area low was sitting at 66.96, which I'm going to mark up a price level here at 66.96, which is going to be right here. So this is going to be our value area low. Now, what we could see here on this footprint chart is this is going to be a delta footprint chart. So we could see all of these negative numbers, meaning aggressive selling, all of the positive numbers, meaning aggressive buying. So what we could see here on the delta footprint chart, and by the way, this is a range bar chart. This is not a time-based chart. What we could see here is we had aggressive sellers push beneath the value area low. We then had sellers try and get aggressive down here again. You could see these larger deltas, -179, -122, and immediately we could see that there's no reward for that aggressive selling, and we reclaimed above the value area low. So what I would wait for in this situation is for trapped selling and that absorption to still be present at this value area low. So what I would wait for is for price to come back down into that value area low, and I would want to see again trapped selling beneath the value area low. Once I see trapped selling beneath the value area low, then that's when I would look to take this long. And we can actually see there's two ways of entry here. Now, if we actually look at the delta for this cluster, it's basically cumulative volume delta for the cluster itself. We have a -365 delta with a total volume of 15,500 contracts being executed in this delta. And what I would be waiting for in this situation is one of two things. If I can establish that we have trapped selling, which we could see -108, -32, -18, -18, and then we see price start to push back up, giving me two conflicting stories, letting me know that absorption is still present. These sellers are still punching a wall and they can't get through. I would wait for aggressive buying to come in to then re-long this market so we can see where this +48 delta is. I would long the market there with the stop loss beneath the absorption, beneath the low, so my stop loss is protected by the passive aggressive buyers. If I want to play it a little bit more conservative and have a little bit of a larger stop, it's a higher probability setup. I would wait for this cluster to show me buying strength, which you could see up here at the 6700s. Enter there with a stop loss beneath the point of control of this candlestick, which the point of control on this candlestick is going to be right here. So then the entry in this accumulation range would be just right after we see aggressive buying, stepping in back above our value area low, and then that would be the entry signal for me with the stops beneath the actual low itself, which you could see here. As soon as buyers started coming into the markets actually ended up rallying from this accumulation range. And after we get a breakout away from this accumulation range, one of my favorite strategies to actually trade, it is going to be a low volume node continuation setup. So this is going to be an area of high volume. This is going to be a high volume node inside of this market where you see accumulation. An area of low volume, and a low volume node is going to be the complete opposite. So you can see here after the breakout, there's typically going to be a low volume node printed inside of the markets because there wasn't much participation from the auction here and the participants in this area. So what I like to do is mark up that low volume node and where we see that low volume node inside of the market. So this is going to be the low volume node here. You can see how drastically volume dies off right here after this breakout. What I want to establish is that we actually pushed above. We started to see some volume being generated, a pullback into that low volume node. And if that low volume node holds, that's when I would continue to go long here, which you can actually see right at this candlestick here. If we were to actually drag this down and pay attention to here, bearish candlestick, buyers were coming in, no follow through with the sellers. Buyers coming in again, no follow through with sellers. Buyers coming in again, and we had follow through with the sellers, confirming the buying strength and that there is real aggression behind this move. And now how can we tell that these institutions are quietly exiting their positions? Very simple. What we see here is the initial accumulation range inside of this area. So this is going to be the accumulation and the distribution. As soon as this move starts pushing higher and higher and higher, what you're going to see is another fat area or another high volume node generated near a high where these institutions were exiting their positions, which you could see was 15 minutes. You could see positive deltas up here. You could see the negative deltas over here. And you have to take into consideration when you're using these stop orders and these limit orders to get filled out of the markets, really what it's going to have to be is a lot of people are going to have to be buying into their sell limit orders to get filled. And then you could see how we had a little bit of a drop off there. So you can see here's the initial accumulation and here's where you have the distribution where we have more volume being transacted on the day at this very high. By the way, if you want to learn how to read order flow and volume profile like the institutions do, I teach traders this exact approach. Just check the first link in the description to see if you qualify now. Most people don't realize this, but retail traders historically couldn't have access to the kind of data that we have access to today. Order flow, footprint charts, depth of market, all of that was locked behind institutional desks. Retail traders back then were stuck with delayed quotes and simple charts, while big money had the real-time view of where buyers and sellers were positioned. But technology today has completely changed that. Platforms like Sierra Charts, Bookmap, and ATAS now give individual traders access to tools that were once only available to banks and hedge funds. We could see limit orders on the book, large trade absorption indicators, imbalances, and things that used to be hidden from the average retail investor. The crazy part is that most traders don't even know that this information even exists. They're stuck chasing indicators and chart patterns, not realizing that the data that actually moves the market is available at their fingertips. And that's the main separator. Traders who are using this order flow and institutional data, they're playing a completely different game than those who don't. So how do you actually start thinking like an institution? It begins with a mindset shift. When I first started trading, I looked at charts like most beginners, indicators, trend lines, and really hoping for a perfect setup. Now I approach the markets and I ask myself, where's the liquidity? Who needs to buy? Who needs to sell? And where are stops building? And how can I position myself along with the big players and market makers? That is what institutions ask themselves every day, and it completely changes your approach. You stop chasing breakouts blindly and start anticipating why price is moving and where it's likely to go next. But now let's talk about reality. You're not going to beat the banks at their own game. They have speed, they have technology and capital that we simply can't replicate. But here's the edge that retail traders actually have. It's flexibility. We don't need to move thousands of contracts. We don't need to scale in and out with precision. We can pick our spots, trade around liquidity, and take advantage of the same setups institutions create without ever competing with them directly. The goal isn't to fight the big money. The goal is to understand what they're doing and align yourself with their flow. Trade smart, and that's how you build realistic expectations using institutional trading strategies. Not chasing every move, but waiting for those key spots where odds are stacked in your your favor. And at the end of the day, success comes from adopting an institutional mindset while still using the advantages we have as individuals. Banks and institutions will always have advantages: more capital, fast execution, market moving power, but they can't hide their footprints. When you learn to read order flow and volume profile the way professionals do, you stop fighting against the smart money and start following it instead. The information is literally there for anyone willing to learn how to read it. Most traders just simply don't know it exists. And if you want to learn how to use what the institutions are doing and use that information to your own advantage in your trading, click that very first link in the description below, and I'll see you in the next video.